All right, let's dive right into a tax issue that trips up a lot of people, but is actually pretty fascinating when you break it down. We're going to do a little forensic investigation, digging into the discrepancy between health savings account contributions on your W-2 and what you're supposed to report on Form 8889. And trust me, this isn't just about plugging in numbers, it's about understanding a fundamental clash between two completely different worlds, how payroll works and how tax accounting works.
So here's our game plan. First, we're going to tackle what I'm calling the Code W Conundrum. That's the central mystery. Then we'll deconstruct the evidence, looking at the key forms involved. After that, we'll see how the IRS helps us bridge the timing gap between them. Then, the fun part, we'll apply what we've learned to solve some really common discrepancy scenarios. And finally, we'll look at the aftermath, what to do when things go wrong, and a few major complications to watch out for.
Okay, let's get right to the heart of it. This is the exact issue that can bring your tax prep to a screeching halt, leaving you wondering if someone made a huge mistake.
So, picture this. You've been meticulously tracking your pay stubs all year. You know for a fact that you contributed exactly $4,100 to your HSA. But then you get your W-2. You look at Box 12, Code W, and it says $7,100. Your first thought is probably, uh-oh, payroll messed up, but did they really?
And here's the big reveal. 9 times out of 10, this is not a payroll error at all. What you're seeing is a systemic disconnect. It all comes down to the fact that payroll operates on a cash basis. It reports money when it was actually paid. But the tax world, well, it operates on a tax year basis. It only cares about which year a contribution was for. That difference right there is the source of the entire mystery.
So to solve this thing, we need to act like detectives and analyze our primary evidence. And in this case, that means the tax forms themselves. Each one tells a part of the story, but from a totally different point of view. First up, the W-2. I want you to think of Box 12, Code W, as a simple cash basis aggregator. It's basically one big bucket. It just adds up every single dollar that was sent to your HSA through your company's payroll during the calendar year. This includes 2 things: any money your employer kicked in, and the pre-tax money you had taken out of your own paycheck. To the payroll system, it's all just one lump sum. Now, this is where we get a major plot twist, and it comes straight from the tax code itself. Internal Revenue Code Section 125, this is the rule that governs cafeteria plans, where you can pick pre-tax benefits. Under this rule, when you choose to make a pre-tax contribution to your HSA, the law does something kind of weird. It legally recharacterizes it. For reporting purposes, it's treated exactly as if your employer contributed it. That's why it all gets lumped together under Code W. As far as the W-2 is concerned, your employer made the whole contribution.
Okay, now for our second piece of evidence. Form 8889, specifically line 9. This line is playing a completely different game. It doesn't care about payroll dates. All it wants to know is the tax year value. It's asking for the total employer contributions that were designated for this specific tax year. And that's where the conflict really begins.
This chart just lays that conflict out bare. The W-2 is all about the cash basis, what was paid between January 1st and December 31st. But Form 8089 is on a tax year basis, what was contributed for that tax year, even if it was paid a little before or after. They're literally measuring 2 different things using 2 different timelines, and that's exactly why the numbers don't always match up.
So how in the world are we supposed to reconcile these 2 completely different ways of reporting? Well, luckily, we don't have to guess. The IRS actually provides a specific tool designed to bridge this very gap. Let's take a look at the official solution.
And here it is. This is our smoking gun direct from the IRS. This is from Notice 2008-59, and it says it all right there. Contributions you make for the prior year are still reported on the W-2 for the year you actually make them. So if you make a contribution in January of 2025 for your 2024 HSA, that money has to show up on your 2025 W-2. This isn't a mistake, it's a feature mandated by the tax code.
So how do we actually do the math? We use this, the Employer Contribution Worksheet. You can find it right in the instructions for Form 8889. Think of this as our reconciliation engine. It's pretty simple, really. You start with the total from your W-2. Then, you subtract out any money that was paid this year but was for last year. Then you add back any contributions for this year that might be paid early next year, and boom, what's left is the correct tax year value that you put on Form 8889, line 9.
All right, now that we've got our secret weapon, the worksheet, let's put on our detective hats and apply it to solve 2 of the most common cases that tax professionals see every single year.
First up is Case File A, the classic double dip. So a taxpayer sees $3,000 on their W-2. They know they contributed that money, so they put $3,000 on line 2 for their own contributions. But then they also see that W-2 amount and think, oh, I guess I have to put that on line 9 for employer contributions too. Suddenly their form says they contributed $6,000, which is double the real amount.
Now the consequence here is a big deal. The taxpayer has accidentally created a phantom excess contribution. See, that $3,000 was already excluded from their taxable income because it was a pre-tax payroll deduction. By adding it again on line 2, they're basically trying to take a second deduction for the very same money. And you can bet the IRS computers are designed to catch that.
The solution, once you understand what's happening, is actually super simple. Step 1. Just recognize that the W-2 amount is money that's already pre-tax. Step 2. Change Form 8089, line 2, the line for your personal contributions, to 0. Why? Because all payroll contributions, even your own, are legally treated as employer contributions. And the result? Your total contributions are now correctly reported as $3,000. Case closed.
Okay, on to our next case, the lost deduction. In this situation, the employer doesn't have one of those Section 125 cafeteria plans. That means the employee's contribution was made with after-tax dollars and it's correctly included in their taxable wages in Box 1 of the W-2. But the taxpayer just assumes all payroll stuff is an employer contribution, so they put 0 on line 2 and the full $3,000 on line 9.
And this is a really costly mistake because the money was after tax. The taxpayer already paid income tax on that $3,000. By putting it on the wrong line, the form calculates their HSA deduction as 0. They've effectively just thrown away the biggest tax benefit of having an HSA for the entire year.
So how do we fix this one and get that deduction back? It's all about verifying where the money came from. Step 1. Identify that the contribution was made with post-tax money. You can do this by seeing if it was included in your taxable wages in Box 1. Step 2. Correct Form 889. Just move that $3,000 from line 9 over to line 2. And what happens? The form now correctly calculates a $3,000 deduction on line 13, and the taxpayer gets their money back. Another case closed.
Our investigation is almost over. But before we wrap this up, we need to cover 2 last really important points: how you officially fix one of these errors from a past year, and a major complication that can throw a whole new wrench into the works.
So, what if we discover you made one of these mistakes on a prior year's return? You can't just ignore it or fix it on this year's taxes. There's a formal process. Your employer needs to issue a corrected W-2, which is called a W-2C. Once you have that, you, the employee, have to file an amended tax return, which is Form 1040X, along with a corrected Form 8889 to get your rightful refund or pay any extra tax you might owe.
And now for the final twist in our investigation. Just when you think you've perfectly reconciled everything for the federal government, it turns out you might not be done. That's because a handful of states simply do not follow the federal rules for HSAs.
And the difference is pretty shocking. Let's just use California as our example. Federally, we all know employer contributions are tax-free, and your contributions are deductible. But for California state taxes, it's the complete opposite. Employer contributions are considered taxable income, and your own contributions are not deductible. For state tax purposes, your HSA is basically treated like any other taxable brokerage account, and New Jersey has similar rules.
Which brings us to our final and really crucial question. After all that hard work to get your federal W-2 and Form 8889 perfectly lined up, you have to ask yourself, are those same federally correct numbers creating a hidden tax liability on my state return? If you live in a non-conforming state, the answer is almost certainly yes. And that, my friends, is a whole new case you'll need to solve.